it's Chris Kapches. I'm the president of Chestnut Park Real Estate. Today I'm going to comment on the February market results for the Greater Toronto area. Very interesting results. Sort of universal numbers would indicate that the market, certainly as compared to last year, is not doing nearly as well. And certainly those numbers are accurate because if you recall, last year at this time the market was exceedingly strong, in fact so strong that it was operating on a frenzied level. In fact, one might even say that it was operating in a state of delirium. Clearly until we get through the next 3 or 4 months, until we get past April, when last year the provincial government implemented the Fair Housing Plan, we won't see a kind of a regularization of the marketplace. So until then, we'll see these very broad negative variances. In absolute numbers, we were down by 34% in terms of the number of sales compared to February of last year, and our average sale price was somewhat down by 12.4%, but that number is kind of elusive, and I'm going to get to that in a moment. The market is very fractured, and notwithstanding the numbers that I just gave, average sale prices down and the number of unit sales down substantially, in fact we still find ourselves in a marketplace where we don't have enough good product, particularly in the 416 area, to meet the demand. As a result of that, it's not uncommon to see numerous properties come on the market, particularly in desirable neighborhoods that are in particularly good shape, that are turnkey in some cases, where we have a lineup of buyers resulting in multiple offers on those properties to this very day. Again, notwithstanding the negative variances that I mentioned a few moments ago. Those negative variances, for the most part, are driven by the 905 region, where the market has taken a substantially harder hit than in the 416. The 905 region, with the 15% tax on foreign buyers, was dramatically impacted when the government implemented its measures to cool the market in April of last year. We did not see that much foreign buyer activity in the 416, and as a result, we haven't seen as negative an impact on the market in the beginning of this year. I think we're going through a period where buyers and sellers are trying to come to grips to an understanding as to what is going on in a very short period of time. The fluctuations have been difficult to understand, not only for buyers and sellers, but they've been difficult to understand for professionals in the industry. The concern that I have going forward is that in the 416, as I mentioned a moment ago, the inventory levels are not strong. The demand continues to be strong, and we could see not necessarily a repetition of what we saw last year, but we could see market conditions tightening again as we move through the year, and some of the inventory becomes absorbed. We will continue to see that in the case of, as I said, those desirable properties, where they will not only be absorbed, but they'll be absorbed quickly with multiple offers from multiple buyers with respect to those properties. The other area that's of concern is the condominium apartment market, where inventory levels are exceedingly low, and the new inventory that came on the market in February is, in fact, particularly in the 416 area, even less new inventory that came on the market last year at this time. I'm particularly concerned about that area of the market because it is the most affordable area of the market, particularly as a result of 3 mortgage interest rate hikes, and particularly because of the new stress testing that began in January of this year. A look at the high end of the market, that is what's driving the average sale prices downward. There are just simply much fewer high-end property sales this year than there were last year. And particularly I'm referring to detached properties, both in the 416 and in the 905. In February, there were 126 properties that had a value of $2 million or more that sold during the course of that month. That is a 67% decline compared to the number of properties that were valued at $2 million or more that sold in February of 2017. That huge disparity of sales is clearly impacting the average sale price, because obviously those properties are the most expensive ones, so if they're factored in to the total number of sales that took place during the course of the month, the average sale price would go up if we had more sales at that price point. Obviously, since we don't have them, it has pulled the average sale price down fairly dramatically. In other areas, the semi-detached properties, particularly in areas such as Riverdale, Leslieville, the Beach, we're seeing almost no change compared to last year. There's a dire shortage of product, and when properties do come on the market, they sell very aggressively and often for prices substantially above the asking price. So as I said, a very mixed market in February of 2018. I do believe that we have to wait for 2 or 3 more months, as I mentioned earlier, for the market to regularize so that the effects of the fair housing plan that was implemented last year are fully understood and fully ingrained in the marketplace. And until that happens, you're going to see these fluctuations, these negative variances, and you're going to see a lot of negative commentary in the press that doesn't drill down and analyze the market in the way that I'm trying to do so for you today. So I think we have to be patient, but in the 416, the market remains strong, inventory levels are low, demand is high, and as we go forward, hopefully that doesn't result in a situation where demand starts to exceed the supply and we get a buildup of a little bubble like we did last year when we saw markets literally, as I said, operating in a state of delirium. So until we get to the next report, that's where we find ourselves in February 2018. Thank you.